Residential Sales Comparison and Income Approaches, page 158. Available. It is the amount a property should command in an open and competitive market. And as we just mentioned, market rent could be more or less than contract rent. In some cases, the contract rent of a property may reflect or be the same as market rent. When the market rent exceeds contract rent, the difference is called deficient rent. Deficient rent. The lessee has the advantage and the lessor is at a disadvantage. For example, a property is leasing for $750 per month. However, the appraiser's analysis indicates that property should be leasing for $900 per month. There is a $150 per month deficit. When contract rent exceeds market rent, the difference is known as excess rent. In this case, the lessor has the advantage, leaving the lessee at a disadvantage. These items become important as we discuss valuation of leasehold and leased fee positions in a later chapter. For example, a property is leasing for $1,000 per month. The appraiser concludes that the market rent is $800 per month. There is a $200 per month excess rent. Market rent is used in assignments when the fee simple interest, unencumbered by any lease or freely available, is the interest being appraised in an assignment at market value. Measures of income and benefits. If one reflects on the fundamental principle of anticipation and an income-producing property, or a property for which there is income potential, there are several different benefits of owning the property that immediately come to mind. Obviously, the one thing that most owners of an income-producing property expect is an income flow. A return on the owner's investment is typically anticipated, and most every investor expects the value of his investment will grow at a profit in an eventual sale of the property. Appraisers have several mechanisms that are used as part of some or all income analysis to measure the efficiency of an investment, depending on the scope of work in the assignment. These concepts include potential gross income, effective gross income, net operating income, and reversionary benefit. Page 159. Potential gross income. Potential gross income, PGI, is the income that could be produced by a property in an ideal situation with no vacancy or collection losses. For instance, a tenant who failed to pay rent and it could not be collected. The key here is that PGI is the income a property could generate if the property is fully rented and occupied during the particular period being analyzed. In most cases, PGI is based on an annual amount. Effective gross income. Effective gross income, EGI, is the potential gross income less vacancy and collection losses. EGI is the income that could be or is realized from an income property after deducting an amount for vacancy and collection losses, but before any operating expenses are considered. If PGI is what the property owner could have taken in, EGI can be thought of as what that property owner did take in. The formula for EGI is you take your potential gross income, PGI, minus vacancy and collection losses. That'll equal your EGI, effective gross income. Net operating income. Net operating income, NOI, is the income after expenses. In other words, net operating income is the effective gross income minus operating expenses. Operating expenses are discussed later in this chapter. Do not confuse NOI with cash flow. Cash flow considers other obligations such as payments toward loan debt and income tax obligations that are not considered in the NOI. The formula for NOI is PGI minus vacancy and collection losses equals EGI. And then you minus operating expenses from the EGI. That'll equal your NOI, net operating income. As mentioned earlier, PGI and EGI are most commonly expressed in annual terms, as is NOI. Reversionary benefit. The reversionary benefit is typically a sum, often stated in dollar amount, that a property owner will receive when or if he sells the property at the end of the investment term. That's highlighted. Know that one. There are several different methods of measuring the reversionary benefit, but several different methods of measuring the reversionary benefit. But to make it simple, it can be thought of as the net proceeds when and if the property is sold. In most cases, typical investors expect that the value of a property will grow over time for one reason or another. Note, analysis that consider reversionary benefits are not typically associated with most common residential income analyses and are beyond the scope of this course. However, appraisers should be familiar with these terms and concepts, which may be explored in greater detail in more advanced coursework. Anticipation, as applied to the income approach, could be the expected income, return on investment, and growth in property value.